stabilised, which is good news.
Okay, Neil, thanks for coming in. Short and sweet today. Do you have a very busy show? We appreciate your input into it. Neil McKinnon, Chief Economist at AVSEQ Group. Chloe.
Well, Becky, let's move on to China, where the markets today pretty much shrugging off reports saying the government is getting ready to tighten those capital requirement rules of banks. Well, this comes as an official think tank warned that a sharp drop in lending would hurt the economy. Now, here to help us make sense of these markets is Graham Beebe, Managing Director, Richmond Asset Management, joining us live from Hong Kong. The interesting thing that we have to point out really today is this report about perhaps tighter capital requirement rules. That really spooked the rest of the markets here in Asia. On the other hand, it looks like Chinese investors taking it in their stride. What happened here?
Well, with our view on the market in China, obviously people are a bit concerned whether the extent of the rally from the beginning of the year was overextended. So we think this is actually an accumulation time for getting back into China. We're in the first wave, I think, of infrastructure spending in China and also in the US. The US stimulus package, which was for infrastructure, actually hasn't been, $1 of it hasn't been spent yet. That's actually going to start happening now. So this is normal jitters. The Chinese are a bit concerned things are getting overheated. So for us at the moment, we're not too concerned about China. We're looking at that one to be a sort of benchmark for where we should be investing elsewhere.
That's right. That's why you actually have some people saying Hong Kong is a better gauge of the fundamentals happening in China. Another interesting thing, there seems to be a lot of rumors that somehow the equity markets will hold up before the big day. That would be October 1st, the national anniversary marking 60 years. Do you subscribe to that view at all?
Well, I certainly think China is a good proxy for China. We're looking at Taiwan as an investment area right now in preference to China. But in Hong Kong, you can see that the residential property prices have increased significantly since the beginning of the year. Us as a company, you know, we're at the front of all this. We're absolute return managers, and we're finding that we're getting inflows of funds, and we're actually out searching for new offices because we're on a recruitment campaign for new advisors. And what we can see is the office rentals are starting to tick up already. So we think that bottom's in place, and it's a good sign for the economy.
If that's the case, then let me slip in an extra question. China is one market, if you are somehow involved in it through the licensed institution as a foreigner, it is one market that you cannot short. Therefore, is it time to get out, or how do you see this?
Well, I think people are panicking about China. For us, you look at China as an investment on its own, and you look for what I call the China effect. So, as you know, China's been buying all goodies worldwide because they know that the recovery is intact, is going to improve. So they're taking resource positions, commodity positions now. Those stocks have been quite depressed. We think they're going to be, at the latter stage of the year, they're going to be probably the forerunners in this. Right now, our preference on a momentum basis has been financials in the US, and especially financial ETFs, because they were down almost 98%, which is crazy. They've started somewhat upward momentum now, so the percentage gain possibilities there is huge. And as at 3 weeks ago, we started to invest in the real estate sector of the exchange-traded funds in the US. Again, down somewhere in the region of 95, 98%. Property prices haven't gone down that much. It's an overreaction. So we would be thinking China is okay. We've had a bit of a profit taking. We're not in China directly at the moment. We're waiting for this pause to wear out. We prefer Taiwan, and we want to see where the ripple effects of the China money infrastructure spending is going, and that's going to be boosting the resource sector again.
Hi, Graham. Matt Nesto in the States. I wanted to ask your opinion, maybe some historical analysis, if you will, in terms of how good, how predictive these think tank GDP estimates have been historically.
Well, for us, we're a momentum and trend-following company. So we're absolute return in nature, and we look for money flows and where the flows are going. For me, the talk of, GDP forecasts and all the rest of it, well, what happened when the markets fell off the cliff? That didn't do anybody any good because people extrapolate these figures forward. All we can say at the moment is the correction that was happening in July is over, and people are buying on the dips again. China does seem a bit stalled, but there are plenty of other markets that are really lively at the moment. And as I say, the real estate and the financials, also the biotech sector, and stuff like Rio and BHP. These are premium companies. Also in Hong Kong, we mentioned about China. We've got the China effect here.
Hey, Graham,
so
we've got to go. We're just about running out of time. We're so sorry, but really appreciate you having on the show.
Thank
Great
you.
to talk to you. Have a fabulous weekend. Graham Bibby, Managing Director of Richmond Asset Management there. His take on China.